Well, a bit of a choppy ride. You're watching closing trades right here on ET now. Much unlike yesterday where it was a steady move, it's not quite the same. You've had your fair share of jagged edges today ahead of the monthly expiry this week. So there you go. The Nifty just about consolidating around the 23,700 mark. And we've dipped into the red, to be fair, almost 3 times today. So just mildly higher. That's where we're currently positioned with names from within the cement pack and of course some of the IT names which continue to see a rebound. Today is no different. Much like yesterday, you've got an Infosys and HCL Technologies which are holding up. And then, of course, within the mid-caps, you've got a big move coming on a Coforge as well as Persistent Systems. Coforge is higher by about 3.6% right now in the futures. And that's pretty much the move on Persistent as well. So from an extreme oversold move, not as much for Persistent to be fair, but the rest of the IT services play, they're all the ones which are rebounding very, very smartly in trade. What's weighing heavy on the indexes today, once again, is IndusInd Bank. Even though the stock is in an F&O band, still down about almost 5%. M&M, ICICI Bank, Adani Enterprises, Reliance, L&T, SBI. The blue chips are the ones which are, dragging the Nifty lower. So it's a bit of a tug of war between those names. And then, of course, the likes of an Axis, HDFC Bank, TCS and Bharti on the other end of the curve. For the broader markets as well, it's been quite a flip-flop, and right now as we speak, it's a decisive move in favor of the Reds, with pressure points being your Dixon, which is down about 5.6%. Zomato is sharply lower. It's an over 5% fall that you're seeing on that stock today. HFCL, Kalyan Jewelers, these are all the other laggards in trade. But let's pick up the conversation forward. We've got Pankaj Pandey, Naresh Mirani, Kunal Bothra, all of them joining in to talk about which way they feel the markets are headed. Naresh, hi, afternoon. Let me come to you first. What is it that you're making of the trend in the market today?
After the recovery towards the previous swing highs of 23,800, 850, we've taken a bit of a pause, and that should be normal given the extent of the rally, almost 1,800 points from the low. But we've seen a little more of a dip on the small cap and the mid cap indices, and we have another three sessions to go for this year to end. We could continue to see a range bound move, but at a higher base at 23,500 to 23,800 for the next 3 sessions.
That's the take coming on the markets. Good afternoon to you, Naresh. Good afternoon to you, Kunal, as well as Pankaj. And Kunal, let me come to you and get your view actually coming in on the way the setup has been like. Given the fact that, yes, we've seen some sort of profit booking kick in, should one actually take this as the new norm that every time you'll have markets rise and rise so swiftly, you will see bouts of profit booking?
Yeah, you should see a good amount of profit booking at every interval, because that's a healthy sign of the markets consolidating and trying to digest the gains which you've been going through. It's almost like an 1,800 to 1,900 point rally on the Nifty, what we've seen in the last 7, 8 days or 10 days odd, over the last 2 weeks specifically. So I think it's a phenomenal up move for the index, and especially at a point where the markets or most of the market participants were not anticipating any kind of such a strong up move. Now, when you're coming closer to a resistance points, you're looking at retracements, there are bound to be a point where the index consolidates. There are important technical levels which we are looking at 23,800, 24,000 mark, the 200-day moving average, the 50% retracement of that 4,000 plus point fall which we've seen in the last 6 months for the indices. So a lot of reasons why the markets are bound to consolidate, and I believe that that's a healthy sign for the markets overall.
Pankaj, hi, afternoon. Do you also believe that up until now to, April 2nd, next week, in any case being a truncated one, the market will be a little bit quiet ahead of that big tariff deadline?
Oh, yes. I think what we believe is that with this kind of a move, probably we might witness some kind of a resistance at 23,800 kind of a level, and possibly we could sort of come down to 23,000 kind of levels. Unless something dramatic does not happen, especially on the tariff front, we would want to believe that the bottom has been made. Largely because most of the domestic macros are fine. On the earnings side, we are expecting about 14% CAGR growth in earnings for next 2 years. Post-correction, Nifty valuations was somewhere about 17.5 FY27 times. So those are fine. Most of the macroeconomic variables domestically have been fine. I think it was the larger issue with the tariff-related anxiety which has been playing its role. So if you don't see much dramatic something happening there, then I think we would want to believe that once the market corrects to say something like 23,000 kind of level, then probably 25,000 kind of a level is very much on the cards.
Pankaj, I just wanted to get your views actually coming in on the likes of what exactly is happening to the two-wheeler space in particular, and the ones that have exposure to the electric vehicle space. You have the finance minister a short while ago actually talk about the fact that the budget has proposed to go ahead and cut that a duty on about 35 of the items which are actually linked to battery manufacturing for EVs. What's your take on this, and how should you play this theme?
So I think in the entire auto as a space, one can be selective because you look at a segment like CV, there's hardly volume growth is going to be in low single digits. You can't have pricing which will help the stocks to sort of deliver. Same is the case with two-wheelers. I think two-wheelers already 9 months had seen a pretty good growth rate. But from here on, one needs to be selective. So which is why we feel that Tata Motors probably looks better than the rest of the players. They are already clocking 90,000 kind of a volumes on a monthly basis. Or in case if I have to sort of name one more, then it would be Bajaj Auto. I think the stock has seen a fair amount of correction. So that is another. On the PV side, most of the players are struggling except for M&M, which is expected to deliver mid-teen kind of a volume growth. On top of it, our sense is that Q4 will witness about 15% kind of a growth in tractors. So one needs to be very selective in the entire auto as a space at this point in time.
We're on the subject of two-wheelers. The newsmaker Ola Electric, they continue to reel under pressure. But tracking the latest news flow on the counter, their arm, Ola Electric Tech, has settled dues worth about 26 crore rupees. My colleague Aishwarya Patil is here with the latest details.
Well, troubles in one form or the other seem to be resurfacing for Ola Electric, and this time around it's its subsidiary Ola Electric Technologies. In this particular matter, it has settled dues over 26 crore rupees with Rosmerta Digital Services. Now, as far as this company is concerned, it has been facilitating Ola Electric Technologies with its vehicle registration process, this service that they provide for their Vahan portal. Now, Rosmerta earlier this month filed a petition with the NCLT Bangalore alleging payment defaults by Ola Electric. Ola Electric Technologies, on the other hand, has now cleared all the dues totaling over 26 crore rupees, and following the payments, Rosmerta Digital Services has also withdrawn the insolvency petition against Ola Electric Technology. So this is the matter so far as this particular case is concerned. Now, the issue comes also on the back of Ola Electric announcing some discrepancies related to its vehicle registrations, that the numbers shown on Vahan portal are not updated once. This comes of course amid this kind of back and forth between Rosmerta as well as Ola Electric. Now, all in all, the settlement does mark a significant step for Ola Electric in resolving its financial disputes as well as stabilizing its operations.
All right, thank you so much for that, Aishwarya. Ola Electric today is down about 2.8%. And Kunal, this one has not had a good ride at all, given the fact that the news flow has not been supportive. Every day you have something or the other actually hitting the stock price as well. As an investor, what should one do? Or as a trader, what should one do? Play this one in any way or just avoid totally?
Yeah, there are better stocks to trade, frankly,
yes,
because I think you don't want to be stuck at a point where the news flow is so heavy that the stock price trend, even on the back of the news flow, it keeps on deteriorating. So I think I would probably look at much better place in the, even if it's a two-wheeler pack. For example, look at Tata Motors, a stock which has been a class outperformer in the last 3 months, 6 months of the price trend, perched at very close towards its all-time high levels, even at a point where most of the auto stocks, the two-wheelers and the four-wheelers, or many of them are still underperforming. So I think it's always better to go with the relatively stronger names. So avoid Ola is what I would suggest at current levels.
Okay, completely avoid Ola. That's the word coming in from Kunal. We'll take a very quick break, come right back. We'll address all the other buzzers in trade on the other side.
Welcome back. You're watching Closing Trades on ET now. All eyes will be on that big crucial date. That is the April 2nd, when you will have the reciprocal tariffs actually come about. In fact, my colleague spoke to Jamshed N. Godrej, who is the CMD at Godrej and Boyce manufacturing company. And what he's saying is that it's time to focus on competitiveness and not the tariffs. This he spoke at the CII National Manufacturing Summit. So let's go across and listen in.
India has always had high tariffs. Right? Okay, why? Because we wanted to protect industry. What happened in 91? Okay, why did that whole system of deregulation take place? Why were tariffs cut? Why was the rupee significantly devalued? Okay, we have to be competitive. I mean, tariffs is all about competition. Today, industry is pretty good, very strong. Many companies, which are both global companies, Indian companies, everyone, and there are lots of them who are internationally competitive and doing a good job. But India is still tiny when it comes to manufacturing. One of the biggest benefits that China has is scale. So we need the scale also. Now, many industries in India have scale. Okay, the steel industry has scale, the cement industry has scale. So there are many such industries, okay, but everybody should have scale if they have to be competitive. Actually, how you can be competitive with very low tariffs is really the challenge.
In fact, we should bring up that note from the house of UBS on cement as a play, and that would be interesting to see, given that today itself you've got some of these cement majors, holding up very smartly, led, of course, by UltraTech Cement. UBS has talked about as to how the bumpy road for cement is only going to get better with time, and they've talked about as to how the rough patch may be coming to an end. They've, of course, upgraded UltraTech, Ambuja, as well as Dalmia to a buy. They've talked about as to how demand is going to bounce back in FY26, and the structural cost reduction could be on the anvil. They talked about how the two market leaders clearly have the upper hand as the consolidation within the sector continues. That's clearly one such case in point, being UltraTech, and Ambuja also is their top pick. Dalmia, of course, they've upgraded from the earlier sell to now maintain, and to a buy, I beg your pardon, and maintain a buy on ACC given its supportive valuations as well as industry tailwinds as well. For UltraTech, of course, they believe that they've shown a very strong execution in tough times and led the industry in growth as well as margins. Pankaj, what are your thoughts on whether cement could be a good contra play right now?
Absolutely. I think so. In cement, if you look at the last 4 months, we have seen a price hike of about 20 to 25 rupees per bag. I think except South is the only region where the prices have been rolled back. So there the hike is only in the range of say 3 to 5 rupees per bag. And then there was one minor issue with petcoke prices going up by 20-25%, but that would have implications of say 70 to 80 rupees on a per ton basis. But our sense is that this is one sector has already sort of a fair amount of struggle. Prices are at more than a year low. So our sense is that with industry consolidating, there are better days ahead. And also our sense is that since we'll have lesser number of elections, so your overall volume growth is expected to be a lot more better at high single digits. So we like this entire space for a 2-year perspective with the likes of, say, UltraTech, Ambuja Cement, and then both JK Lakshmi and JK Cement. I think these are the ones which we are liking. I think southern players, we need to still wait and watch for prices to become better.
Right, so that's the take coming in on cement space as Pankaj's view. But in fact, let's actually hear out what UBS had to say, or what's the rationale behind UBS's upgrades. Snehi is here to take us through all of that. Snehi, over to you.
Well, absolutely. So UBS has come out with a note on the entire cement sector, and then now they have turned very bullish on this sector. They believe that the rough patch that the sector has been seeing for quite some time now has come to an end. Earlier they were negative on this sector, but now they have turned positive and they anticipate an earnings upcycle to emerge in FY26. They also forecast strong growth over FY25 to FY27. So they're very constructive and optimistic on this sector going ahead. They say that demand will bounce back in FY26 and the structural cost reduction is also on the anvil. So companies are also being mindful about this. They also believe that the two market leaders, that's UltraTech as well as Ambuja, have the upper hand as the consolidation in the space continues. The sector is trading slightly higher than the past 5-year mean, which is the 1-year forward EB/EBITDA. And now their individual bets for UltraTech Cement, they've upgraded the stock to a buy rating from a neutral rating, also hiked the target price to 13,000 rupees per share from 9,000 earlier. So it's a very big upgrade coming in for UltraTech Cement. For Ambuja Cement, they've upgraded the stock to a buy from the sell rating, and target price has also been hiked to 620 rupees from 475 earlier. For ACC, they continue to maintain a buy rating on the stock. However, they've cut the target price to 2,250 from 2,450 earlier. And lastly, for Dalmia Bharat, they've upgraded the stock to a buy from sell rating, but they've also cut the target price to 2,100 from 2,160 earlier. So that's UBS's take on the entire cement space, and they continue to be optimistic on the space going ahead.
Naresh, are you seeing the sector bottoming out in any which way when it comes to some of these cement plays, Ambuja, ACC, Dalmia Bharat, or for that matter, the leader UltraTech?
So the leader has been more towards a new all-time high. So the stock is only corrected 10% compared to the rest of the market. You have Shree Cement setting a 52-week high. At the same time, you have a Dalmia Bharat, which is actually on the lower end of the range of the last 3 years. But they did not see a lot of selling pressure after breaking new 52-week lows. So we have one section of the cement names closer to 52-week highs and one struggling. I think the struggling names look interesting for a bounce back. So Ambuja, ACC on dips continue to be a buy for a bounce back back to say 10 to 15% over the next few months.
That's the take coming in on cement. Kunal, what's your view actually coming in on the sector that is actually outperforming today, and that's the IT space? We've spoken a lot about it, but this one is also on the tenterhooks, given the fact what happens globally. What's your take on the charts? How is IT sector looking like to you? And is it the mid-tier IT companies that one should look at, or is the large caps?
Yeah, today I think the mid-cap IT stocks are doing reasonably well. Over the last 2 or 3 days, there's been some bit of short covering which is there into few mid-cap IT stocks. But then I think we'll have to maybe look at this as a phenomena that maybe it's the expiry week, so there could be a bit of juggling of positions over there. What matters is that if these stocks have the wherewithal to try and break past about the previous swing high, so whether it's maybe another 3% to 5% swing high for these stocks, and if that happens, that's where we can probably anticipate that this could be a turnaround sector yet again for the IT index. As of now, it looks like more of a short covering play. It looks like more of juggling because of the expiry. Maybe over the next couple of days, for example, if the IT index breaks past about 38,200 to 50 mark, that's where I would believe that we may probably get a lot more confidence that we are looking at a potential short-term turnaround for the IT index.
Pankaj, what is your own thought on IT? Because even after the vicious correction, the valuations are still rich. Would you say that avoid IT for now? Better opportunities in the market for sure?
So on the ITC, the US is the biggest market, and typically most of the companies that derive 50% of their revenues from them. Now, with this tariff-led uncertainty, the growth which was, or the strong rebound in the growth which was expected in FY26 is now sort of pushed back. And I am not too sure whether we can sort of say in this post results that going forward, we are going to see a strong rebound. So I would expect that since the sell-off has happened, it was one of the worst performing sector in the last 1 month. So some bit of a buying at the lower levels is fine, but I don't see a sustained move in the IT going forward unless we see something big improvement in a market like say US. So one needs to be very selective. So for example, when you look at tier 2 names like say Coforge and say Persistent Systems, I think these are the two companies which you like, and both these companies are available at 2 times PEG. Whereas when you look at a big one name like say Infosys, it's above PEG value, so 2 times PEG. So from that perspective, tier 2 selectively are okay, but in general, I don't see a sustained recovery in IT as an overall segment.
An interesting take coming in on the IT space. Thank you so much, Pankaj, for joining us on the show to give your views on the markets, the sectors that are actually standing out at this point in time. But Kunal, let me come to you, get your closing trades for our viewers.
Well, that's an interesting stock in terms of a potential breakout, and that's DMart or Avenue Supermarts. The stock today has managed to cross back closer to that 4,000 plus mark, so it looks attractive on the short-term play. What about you, Naresh? Which is the stock that you are liking at this point in time?
So that's a buy on Bajaj Finserv. The stock has given a breakout in the near term, a cup and handle breakout, also trying very close to making new all-time highs, expecting it to make a new all-time high on this breakout move. So expecting a target price of 2000 to 2100 in the next couple of sessions.
All right, so there are a couple of closing trades coming in from Kunal as well as Naresh. On that note, we slip into a break on this edition of Closing Trades with the news that the broader market is under pressure. Even Nifty Bank has actually caved in at this point in time.
Back with closing trades right here on ET now. The flip-flop for the market continues and we've quieted down and we are now sub the 23,700 print in trade, but that's okay. It's pretty much been a vertical move up that the markets have seen in the last 1 week or so. But here's an ET Now exclusive, and we are gathering from our sources that eyewear firm Lenskart has appointed 5 banks for its proposed IPO. The draft issue document for the planned IPO is pegged at least at $1 billion and will be likely ready to be filed with SEBI and the stock exchanges earliest by the end of the coming quarter. Anurag Joshi, my colleague, is here with more details.
Eyewear firm Lenskart is moving forward with its initial public offering plans. Lenskart has appointed 5 banks for the proposed IPOs, and these are Avendus Capital, Axis Capital, Citi, Kotak and Morgan Stanley, who will be the book lead managers for the IPO. The company is planning to file the draft issue document with SEBI and the stock exchanges by the end of the next quarter, and the IPO size is pegged at least $1 billion. Lenskart's key backers include Abu Dhabi Investment Authority, Kedara Capital, Premji Invest and SoftBank. Just last June, Lenskart had secured a $200 million secondary investment from Temasek and Fidelity, and at that time the valuation of the company was pegged around $5 billion. The company was founded in 2010 by Piyush Bansal, and it currently operates 2,500 stores, of which about 2,000 are in India. In 2023, Lenskart had received a key investment, and this was $500 million from Abu Dhabi Investment Authority. The company has been planning to go public in the past few months, and now is planning to take this proposal forward.
All right, thank you so much for that, Anurag, for getting us those exclusive details on that particular news piece. But let's talk about Titan on the charts, because talking about eyewear, the one stock that always comes to your mind is Titan, and it is one company that dons too many hats, Kunal, be it eyewear, be it watches, be it jewelry, and you name it, it's there in Titan. What's your take on Titan? How are the charts looking right now?
Yeah, they're looking a lot more better relatively. The stock has underperformed actually, Cheryl, because over the last 2 weeks, the stock has not given any kind of a major rally, which means that there is selling which is going on to the stock price, devoid of the recent correction, as well as with respect to the gold prices, because we are at a point where the gold prices are also at multi-year highs. But that's not gotten to a positive zone for Titan. And I think at current levels of 3,000, the price level is attractive, but the stock lacks momentum. So I think it doesn't fit very well from a short-term play, but from longer-term kind of a time frame, I think at 3,000 odd levels, this could be a good value buy.
Well, that's Titan. Let's see what Trent as well has been up to. Another Tata Group stock has been really battered, breached the 5,000 mark as well, and now just circling around those 5,150, 5,200 odd kind of levels. That, of course, brings us also to the question that while the Nifty has reclaimed the 23,700 and 800 mark also, and it's again about almost of 8% from the March 4 lows, what is it that some of these conglomerate stocks have done? The likes of Adani's, Ambani's, as well as the Tatas. Sharad is here with that analysis.
Well, 3 important groups which we have taken, and do remember from March 3rd lows, the recovery numbers we have taken in. From there onwards, Nifty has gone up more than 7%. But the 3 largest groups which we are tracking, the Tata, Adani and Ambani group, all of them actually outperforming when it comes to the recovery. Tata Group going up as 10%. That's an average I have taken. Of course, all the listed companies in the universe. Adani Group, it's 12%, and also Ambani Group. Of course, largely this is coming from Reliance, but there are other companies as well where they have controlling stake. That has also gone up past the 7% benchmark. Now let's look at which are the key gainers which have come in. For Tata Group, the group average was 10%, but Tata Communication, Indian Hotels and Tata Motors, these are the top 3 picks which we have seen. They have gone up between 15 to 22%. Also up next is Adani Group, with the group average is being 12%. That is going up, of course, more than the Tata Group and Ambani Group. And if you look at it, Adani Energy coming in at 25% gains, followed by Adani Green and Adani Ports, which is roughly 14 to 19 odd percent. Also, lastly, the Ambani Group, largely Reliance is something which we will be focusing on. Reliance is up 11% since March 3, and also followed by Just Dial and Den Networks, ranging between 9 to odd 11%. So largely, the conglomerates have actually outperformed on an average basis when it comes to Nifty's rise from March 3 lows as well.
Interesting, actually, talking about these conglomerates, actually, the way how they've gained, Kunal. Adani Group of counters, apparently they've also outperformed the benchmark indices over the last few trading sessions, given the fact that they have outperformed from March 3 lows. Out of the Adani Group of counters, which one actually you are liking at this point in time?
Yeah, I think relatively these stocks in the last 1 week, 10 days, they would probably have gained traction. But then when you look at this from the 2024, 23, 24 highs, I think many of these stocks have underperformed significantly. So what's happened is that in this phase of correction, the beta of the stocks have changed dramatically. So, you know, Adani Enterprise, Green, Transmission, etc. These were very high beta stocks, and they used to move in swings of 10-15%. Even if the indices moved in a swing of say 3-5%, like what we've seen in the last 8-10 days. But right now, even in the phase of the price correction for the markets, compared that to the Adani Group of names, as well as in this rise in the last 2-3 weeks, the beta has dropped significantly. These stocks have now become more or less market performers. So if you expect the index to rise up by 3 to 5 percentage points, you expect the pack overall to try and just about give very similar kind of returns. And out of the pack so far, I think Adani Ports is something which looks fairly attractive. The stock has managed to hold on to that 1000 mark even after falling out from 1700, 1800 levels, and then gone through a time-wise consolidation. So that could be the only better name which looks attractive at current levels, specifically from a price point.
Okay, that's Adani Ports looking most attractive right now. But let's also hear it out from Dinsha Irani. He spoke with us this morning, and here are his thoughts on where the markets may be headed, how much more headroom this rebound could actually have, and of course, what sectors are looking interesting right now.
We became negative IT sometime in Feb. We were long IT from July of last year onwards. We were fairly bullish, but sometime in Feb we realized that two things actually. One was obviously the uncertainty going on in the US. I mean, already most of the IT guys are calling out that discretionary spends are not picking up at all out there. That's obvious because the way the new admin is creating so much of uncertainty, businesses obviously will hold back. They will not be spending too much. So that was one big concern. The second one, which we always thought was going to assist IT in a big way, was AI. But along the way, we realized that AI is artificial intelligence, that is becoming a disruptor for that particular space. In fact, the model that we always followed is throwing bodies at the work may not in the IT that is space may not be working out. So as a result, we I think sometime in Feb we got rid of all our IT stocks. We just have one which is actually classified as IT, but it's more to do with the auto space. So that's why we're holding on to that one. And when we did that, we raised a lot of cash along the way because we were like at the end of the month we were at 20% cash. But fortunately, the call on IT went well and markets kept collapsing. So we waited. By March beginning, we started deploying the cash again, and I think we've been happier that way. I mean, the IT has gone down and the market's gone up, and whatever we deployed, I think that trade has worked perfectly for us. So today, I don't think we have any cash lying with us.
Dinsha, there are a lot of other small pockets which are now coming to forefront. Consumer durables. It touches everyone's life, but consumer durable companies in India are not very large. You have this entire two-wheeler space which is making a comeback. You've got consumer discretionary stocks which are making a comeback. Anything which looks appealing to you, which in a sense was not the great trade of last 3 years, but could be a great trade for next 3 years?
So, Nikunj, actually in the consumer durable space, unfortunately, it's the way the liquidity had been sucked out of the system, I think that affected consumer durables to a greater extent. I mean, if you see the unsecured lending had gone down by banks, and with the new governor coming in, obviously that space is looking far better, because the first thing that the new governor did was infuse liquidity in the system, and that helps in a way. But I don't see that picking up in a big way anyways. I think it's gonna be a steady pace. Unfortunately, in India, consumer durables are mostly limited to AC companies and a few pockets here and there. But I mean, I don't see even that space doing too well, given that despite the fact that there's enough heat, I mean, as in the season's pretty hot, there's a lot of sales happening, but the competition is eating into that space. So I don't see that space picking up in a big way. We'll be anything that is underperformed last year and is expected to do well, which you will not give me brownie points for, is obviously the financial space. I think banks are the only space that we feel are looking pretty ripe for a good run henceforth from here on as such. Obviously, NBFCs within those will look far better, because I mean, when we're talking about the lender space, because if interest rates are getting cut, that's the area, those are the guys who really benefit going forward. So that way.
Okay, that's IT and some of the other sectors that Dinshaw just talked about. In the meantime, it's completely flattened out for the index, while there's trend Bajaj Finserv and UltraTech Cement, which are holding out, and that's the case with an Axis as well. But can't say the same about some of the other banking counters. Just bring up what an IndusInd Bank is up to. That's still down about 5%. ICICI Bank is the other one which is under pressure, down about 1.25% as we speak right now. So it's a bit of a tug of war between Axis and HDFC Bank on one end, and then of course there's ICICI Bank on the other. IndusInd Bank, let's just keep that out of the list. That is a little bit of a special situation name, if you will. But Naresh, how is it that you're looking at these large private banking plays right now, the positioning of HDFC Bank versus ICICI Bank, and then where does Axis actually come in the pecking order?
So clearly the leadership has been ICICI Bank. The stock has done really well over the last post-COVID, and even in the near term made a quick move to all-time highs. Second is Kotak Bank, which has broken out of a 5-year range, and that becomes a buy on dip now. The next one is HDFC Bank, because it is back to testing that 1800, 1850 mark, which has been a problem for the last 4 years. And then we come to Axis Bank, which has been holding on to the 1000 mark. So this is how the hierarchy starts. It starts with ICICI, Kotak, HDFC, and then Axis.
A take coming in on big banking names. Kunal, let me come to you and get your take coming in on the consumption theme. When you talk consumption theme, it's a very large theme actually. But in that, if you have to break it down further, which is that one consumption spot that you are liking in the market right now? Is it the FMCG, or maybe if you want to put to that list, autos? What's your take?
Both of them are underperformers, frankly. In fact, we did a relative strength study in the recent last 15 days of the 1800 point rally for the index, and in that sense, the only 2-3 sectors apparently which have been underperformers. The first one is actually FMCG in terms of the rank of the underperformance, then followed by auto index, especially the large cap auto stocks which have actually been underperformers, especially the likes of M&M, not showing any major signs of recovery or showing any kind of a pickup in terms of price action. And then the third one was the IT index, except for the last two days of price action where you've seen some recovery for the IT index. But largely, I think both FMCG as well as auto, they've underperformed. And we've looked at the charts for HUL, Britannia, Nestle, etc. Most of these stocks are still grinding into their consolidative ranges. The only good part when we look at the charts is that maybe a medium-term bottom could be at place for these stocks. But with lack of momentum and the selling pressure still not out for these stocks, it just looks like that maybe over the next or the start of the fresh series, these stock would continue to drag. So whenever the markets get back, or if the markets get back into any kind of a corrective phase, there could be a chance that autos as well as FMCGs may lag.
Right, so that's the take coming in on the consumption space. In fact, earlier in the day, we spoke to Pankaj Murarka on the consumption theme, and he did say the fact that he's actually turned positive on this one after a while. Hear out his rationale.
After a gap of almost 5 years now, I have turned positive on consumer as a sector, meaning I have been negative on consumers for the last 5 years because of my concerns around slowing growth and expensive valuations. I think both of them have turned around. So I think valuations now in consumer sector are much more reasonable. And I can see a path to a growth acceleration in the consumer sector over the next 2 or 3 years. So that is one sector where we've avoided largely over the last 5 years. And now we have a meaningful exposure in the portfolio, and we have actually gone overweight versus benchmarks because we are long only. So in a sense, we are relative investors. So we've gone overweight on consumers in our portfolio. So that's a one big change or delta that we've made in the portfolio. And I can lay out my hypothesis. Essentially, if you look at the last 15 years, the private final consumption expenditure has grown ahead of nominal GDP growth. In the last 3 years, the growth is under 5%. So I believe that over the next 3 years, we'll see a sharp rise in private consumption, or the PFC as we call it, from a organized market, which was just about 3 or 3.5 players. Now all of a sudden we have three incremental players. So the competitive intensity in that space has increased significantly, and that is likely to remain in the medium term. So despite Asian Paints being a great company, there is a heightened competitive intensity, and they will end up conceding some market share. And more importantly, it will lead to some pricing pressure and margin pressure in the industry. So probably I think paints is still avoidable. But I think what looks more interesting on the consumption side probably is staples, because I think given the fact that we're coming from a low base of consumption, I think staples will do well. On the discretionary side, probably we like more durables and probably some of the discretionary category across travel, tourism, and probably some of the retail stocks.
Okay, that's the take coming in on some of the consumption plays. Just looking at a couple of other buzzers and Kalpataru projects, they've received an order worth about a sizable 2,366 crore rupees in the transmission and distribution segment of their business. HCL Technologies, they're looking to transition into an AI-led platform operating model, HCL Tech in Western Union, which they're going to be setting up an India-based technology center to foster some innovation as well. Technology, of course, is a big mover today. And then there's GRSE as well, which has said that they've signed a contract with a Germany-based company. And it's a sizable order that they're looking at. The overall contract value remains at about almost $108 million. The GRSE is a little bit quietened down in trade today. Kunal, last week I remember you were talking about as to how GRSE and Mazgaon are looking very strong, right? Within the entire defense pool, do they still seem to be the leaders, or would you say it's always BEL which is the go-to?
Yeah, BEL and HL. So BEL, of course, is one of the go-to stocks without any doubt, because the stock has an absolutely low to moderate beta in different kind of market conditions. That's what is very attractive for a stock like BEL, because you're not susceptible towards the major part of the volatility. And then when the markets get back into the thick of uptrend, this is the stock which starts to get back into a trending mode rather, and not showing any kind of major volatility. But then there are other stocks. So what's happened is, in this last 2 months of the price recovery for the defense stocks, BEL was one of the first ones to try and make a comeback from its previous swing lows. There was a point when the stock was almost 15 to 20% lower than its 200-day moving average. Now at 300 odd levels for BEL, the stock has converged back towards its long-term moving average, which means it's come back towards the neutral territory. Then we look at the likes of HAL, which is still, I think, 10% down from its 200-day moving average. So which means that there could be a good alpha which could be generated from current levels for HAL. But from the other names, most of the stocks, whether it's GRSE, Cochin Shipyard, Mazgaon Dock, etc., many of these stocks, they've actually made a very strong comeback. And the bullish engulfing kind of a patterns on the monthly charts makes the the near-term bottom to be quite strong for many of these names. So which means we are looking at a point where many of these defense counters would have formed a major bottom for themselves. That 40 to 50% correction for many of the stocks in the mid-cap category, that could be behind, and we are now looking at potentially a build-up of a trend for many of these stocks going forward.
Well, so that's the view coming in on the entire defense theme, and which stocks actually stand out in that particular arena. But Naresh, coming to you, let me get your BTST ideas.
First would be a buy on Bajaj Finserv. The stock is broken out today, expecting a move towards 2000, stop loss at 1920. Second is a defensive buy on ITC, which is trying to make a range breakout, stop loss at 407, target price of 416.
Bajaj Finserv and ITC coming in for Naresh. Kunal, what about you?
So I'll go to the ban Avenue Supermart. The stock coming into a breakout just about at 4,000 marks. So we'll look out for targets in the range of 4,200, stop loss at 3,900. And Trent is the other stock after 3 or 4 days of a mild correction. It's coming back into a bit of a breakout or a reversal. So would look out for move, follow through up move. Buy with a target of 5,500, stop loss at 5,000.
All right, so those are the BTST ideas coming in from our experts. If you look at the markets today, yes, the broader markets, about a profit booking actually very visible when you talk about the markets, given the fact that we've seen consistent sharp rise in the markets for at least 6 to 7 consecutive trading sessions. From there on, yes, we've actually now corrected in today's trading session with the benchmark indices trading flat. Cement is one pack. There was a buzz on back of the note coming in from UBS. You have JK Tyre, that one is under pressure in trade today because you have MK that has come out with a note where they've cut the target price for the company. So 2.6% down to come for JK Tyres. While on the other hand, you have Goldman Sachs, which has come up with a note on automakers and related stocks. They believe they are poised to gain given the fact that there is going to be potential pay hikes. They are saying that they're expecting 5 million government employees to get 14 to 19% more per month after the 8th pay commission hike. So on back of that, and also what was the bonanza that we had received in the union budget as well, once that kicks in, hopefully the automakers will actually perform well. Karur Vysya Bank, on the other hand, is the one in focus because you have Access Capital that's come out with a note where they initiated coverage with a buy rating. The stock is now flattened out a tad bit, but had a good ride through the course of the day. And Bernstein is saying that India will gain from potential US recession. Their Nifty target is around 26,500 levels. But Kunal, come tomorrow, what should one expect when you talk about the markets?
Well, I think even if we expect the more or less a consolidation, that could be good enough because we are trying to digest the gains of 1,700-1,800 points on the index. In fact, in the morning also we were discussing that how 23,800 mark could be actually a good point where traders could look to trim out profits or long positions at least by a margin of 10% to 20%, because when you're bound to hit a ceiling or a resistance, the markets take a pause, the stocks get churned, you see fresh sectors evolving into breakouts, and all of that is happening today. For example, you've seen the bank Nifty or the banking index being a lot more tepid. Then you've seen underperformance or correction into the other mid-cap names. The mid-caps and the small-cap index have taken a back seat, and then you have the other sectors like the Nifty IT index, which is trying to offset the losses. So when you see such kind of a mixture, it indicates that the markets would consolidate for a couple of days. The good part is that we are heading to the expiry for the over the next couple of days, and with the kind of up move we've seen over the last 10-15 days for the indices, that should probably trickle into more long positions getting rolled over to the next series.
Okay, that's that on where the markets are headed right now. Just looking at how the closing trends are, and it's quite intriguing as to how there's only cement which is actually the clear winner. Other than that, metals, realty, telecom, power, cap goods, all of these have actually turned out to be the sectoral laggards, as has been the market breadth as well. But you know what, I'm going to thank Kunal and Naresh on that note and hand it over to Snehi for the closing trades.
Well, absolutely. Let's take a look at how today's trading session has panned out for us. Now, a couple of stocks were in focus, and in fact, only a handful of stocks have closed the day in the green, because let's take a look at what the benchmark indices have done first. And let's pull up the Nifty. It's very flat move coming in, a hint of a negative bias coming in. But that could change because, we have seen so many days of gains coming in. Overall, for the Nifty, we have been rather range bound in today's trading session. At one point, we had managed to reach the 23,860 new intraday high for us today, but now we're almost 200 points lower from, in fact, slightly more than 200 points lower from the day's highest point. So that's what's happening on the Nifty, and it's just a 22-point cut coming in on an intraday basis. But if you compare it with the day's highest point, then it's quite the steep cut that we have seen coming in on the Nifty. And no surprises that the Sensex is also largely in tandem with the Nifty. It's almost a 1/10% cut coming in for the Sensex. We've once again receded below the 78,000 mark on the Sensex and 77,850. So, quite significantly under the 78,000 mark on the Sensex is where we are at. An intraday cut of 130 points, but then, yes, once again from the day's highest point, it's quite a steep fall coming in. On a spot basis, it's 0.2% lower coming in for the Sensex. Let's take a look at what Nifty Bank has done. It's been, leading the market one way over the last couple of trading sessions. Yesterday, it was the highest sectoral gainer as well, on the back of both private banks and PSUs participating. Today, on the contrary, Nifty PSU Bank is the biggest loser. Nifty Bank also has not done all that much. In fact, it is underperforming the benchmarks as well. A 0.3% cut coming in on Nifty Bank, and Nifty PSU Banks today is lower by almost 2% in today's trading session. Let's pull up the broader markets. because they have seen steeper cuts today coming in. Nifty mid-cap is lower by a whole percent. In fact, it's deteriorated further, a 1.2% cut coming in on the Nifty mid-cap index. And Nifty small-cap also, it is the biggest loser on the street today. This basket of stocks, a 1.7% cut coming in and 285 points lower on the spot. Barely holding on to that 16,000 level is the Nifty small-cap index. Let's talk about the advanced decline ratio in today's trading session. 2,170 stocks in the red. You only have a couple of stocks compared to that at least. It's a 554 stock group coming in the green today, and very steeply in the favor of the declines is where the advanced decline ratio was today. And on the back of that, let's pull up India VIX. India VIX was also spiking up about 4% in today's trading session. It has cooled off significantly, but nonetheless slightly in the green. Not much to worry about because we had tested those 14.2, 14.3 marks on the India VIX today, and now we have receded from those levels. So at least India VIX is looking steady in today's trading session. Let's talk about some sectoral gainers and losers in today's trade. It was through and through the day of Nifty IT because its global peers, especially on Wall Street, Nasdaq did pretty well. It's a more than 2.5% uptick coming in on Nasdaq in yesterday's trade. On the back of that, Nifty IT has done very well for our markets today, a 1% uptick coming in on that front. The likes of Coforge, Persistent, Infosys, Emphasis, LTS Tech, LTTS, TCS, Wipro, all of them. In fact, HCL Tech and Wipro also had news flows of various collaborations and tie-ups coming in respectively. So both of those stocks have done well. That's a 2.2% uptick coming in on Coforge as well. Overall, the entire IT pack has ended the day in the green. Other than that, Nifty Financial Services is the one that's done decently for itself. That sector is in the green. But barring that, everything else has closed in the red today. Nifty FMCG is the least losing sector, a 0.2% cut coming over there. PSU Banks, a 1.8% drop coming in on that front, followed by media, realty, metal, energy, pharma and auto. Nifty FMCG is the least losing sector in today's trading session. Let's talk about a couple of stocks and sectors that were in focus. The entire cement pack was in focus today on the back of a UBS note coming in, wherein they're very bullish on the entire cement space. They've upgraded UltraTech, ACC, Ambuja ACC, they've maintained a buy. They've upgraded Dalmia Bharat as well, but Ambuja Cements has given into the market pressure. It's 0.2% lower. UltraTech Cement is the real outperformer in today's trade, a more than 3% uptick coming in, and it's the stock that has been giving some life to the Nifty on an overall basis because it's the biggest Nifty gainer in today's trading session as well. Kalpataru Projects has bagged an order over 2,366 crores, so that stock was doing up pretty well in today's trading session. Garden Reach has seemed to give in to the market pressure because they have also bagged an order win for 2 more MPVs with a German firm, so that stock is also held up mildly in the green today. But nonetheless, that's all we wish to highlight on this edition of Closing Trades. And today's trading session, we have unfortunately ended with a slightly steeper cut, and we've struggled to hold around the 23,600 mark. We'll give the rate some time to settle, but this is what it's looking like at the closing bell today.